Good afternoon, and welcome to Finley Davies webinar. We encourage questions via the chat window, which can be accessed by hovering your cursor over the green tab at the top of your screen. From the toolbar, click Chat. We will try to address submitted questions at the conclusion of the webinar, although because we just have 30 minutes, we may not be able to respond to all questions. This webinar is being recorded, and the recording will be available on the Finley Davies website. You will receive a link to the recording in a follow-up email. I said good afternoon, everyone. My name is Matt Klein. I'm a fellow of the Society of Actuaries and a principal in the firm. And today's topic is Pension Wars, Rise of De-risking. If you saw from our marketing materials, we tried to have a little fun with the popular movie around the holidays, but in order to avoid getting any calls from Disney lawyers, you're not going to see any lightsaber battles, nor are you going to see references to the Force in today's presentation. However, there are many forces at work, and we'll be going through several of those as we go through. Again, we just have about half an hour today, so we're going to move quickly, and we're going to jump right into it. And there we go. All right, so our agenda for today is, our topic again is de-risking. We're going to start out talking a little bit about what exactly de-risking means, and for purposes of today's conversation, we're really going to focus on terminated vested cash outs and annuity purchases. Certainly there's other forms of de-risking, such as liability-driven investing and asset liability management and those kinds of concepts. But those really aren't going to be the focus of today's topic. We're really looking at really kind of shrinking the plan and looking at de-risking from from bringing the participant count down. And you'll see quickly as we go through this, there's many reasons to be looking at that right now. So just for background purposes, what exactly is a terminated vested cash out? So we're looking at our population of participants that have left the company but haven't yet started their benefit. So we're talking about that in-between group, the folks that have left but they're not yet in payment. And what we've seen several companies do over the last few years is open up a window, a temporary window, usually 45 days, and give all of those or a subset of that population an opportunity that in lieu of their promised benefit at retirement to take a lump sum in cash instead of that annuity. And we have seen that be pretty popular over the last couple of years, and as we're going to move through this presentation, you're going to see that 2016 really is probably a good time to revisit it if you've talked about it before and haven't done it. We're also seeing interest by some companies that have done terminated vested cash outs in the past, looking at doing that again, doing a second bite at the apple here in 2016 because of the way the economics of it work out. The other kind of de-risking that we'll talk about today, it would be doing an annuity purchase. And so here we're really talking about the retiree population generally, although that can include the terminated vested population if you like. And this would be going out to an insurance company and getting them to, and paying them to take the associated risk and the benefit payments associated with your population off of your hands. I often liken this to moving from a self-insurance model to a fully insured model. As long as those retirees are in your pension plan, you're managing the interest rate risk and certainly the investment risk of the assets underlying those promised benefits. and going to an annuity purchase, would remove all of those risks. But there's usually a premium that you have to pay an insurance company to take those risks for you. Annuity purchases were very popular in 2015. In fact, the size of annuity purchases for 2015 was larger than 2013 and 2014 combined. And again, we're expecting a strong interest in annuity purchases in 2016 as well. And when we talk about annuity purchases, we've also seen an increase. That doesn't mean necessarily that you're getting rid of your entire retiree population. We've seen an increase in tiered purchases, where we have seen companies look to remove some of their smaller benefits or older folks, depending on what makes the most sense, look to move those out of the pension plan first, and then maybe when conditions are more favorable, look to do a second annuity purchase later on. So we've seen that kind of strategy implemented as well at companies. So the next several slides are really going to talk about why 2016 is pretty much is really we're anticipating a really good time to implement some of these de-risking strategies. So we're going to present a number of different topics here. What's influencing the cost and the pricing of doing one of these de-risking events, and why 2016 might be a good time to pull the trigger. So the first one we're going to look at is looking at mortality. And as probably most pension plan sponsors know, the Society of Actuaries, the SOA, released a new mortality table in October of 2014, which was the RP 2014 table. It was the first major update to mortality since the year 2000. And more importantly than just updating mortality for increasing life expectancies over the last 15 years or so, these new tables introduced and made widespread this concept of generational mortality. And what that really means, as opposed to older tables, is that we're assuming that mortality is going to, or life expectancy, I should say, is going to improve every year off into the future. So that when we're doing our mortality tables now and looking at each year, we're saying that a 60-year-old today, they have a better chance of dying than a 60-year-old will that's going to be 60 in the year 2030, because we're going to continue to see advances in medicine and treatments. And so we're also building those kinds of factors now into our liability determinations as the mortality tables have gotten more complicated, and technology allows us to implement these kinds of sophisticated modeling. In 2015, then, the Society of Actuaries did release a second projection scale dubbed MP 2015 that was released, that was a little bit less aggressive than the improvement factors that came out in the original release, the MP 2014. With MP 2015, basically what we saw and what the statistics backed up was the mortality improvement that the first couple years of the new table, what it projected, were not quite as high, or actually were more high than reality, meaning that we were seeing more deaths than anticipated by the new tables, and so there was a slight adjustment to the mortality tables. But overall, we're still seeing increased life expectancies, which of course increases the amount of annuity payments that retirees and future retirees will receive, which increases the liabilities. Now, it's important to note that RP 2014, the implementation of those tables really have occurred as for GAAP purposes or for accounting purposes. These tables have not yet been implemented for IRS minimum funding calculations, in PBGC variable rate premiums, and most importantly for determining lump sum calculations. There's reasons the IRS, hasn't adopted these tables yet, and that's because there's several issues that they have to work through in setting a new table, as far as which projection scale they're going to look at, how do you implement annuitant and non-annuitant tables that are becoming more widespread. Are they going to implement this generational mortality concept? So they have all of these different issues that the IRS is grappling with. It is, however, the opinion of most practitioners and most professionals. We do expect at some point in 2016 that the IRS will release a new mortality table for that will begin January 1 of 2017 that will affect the 2017 minimum funding calculations and the lump sum payments that would be paid out in 2017 and beyond. So as we look at the current lump sum table that we would use for lump sum determinations, for someone retiring at age 65, they would have a life expectancy under the current table of 243 months, or just over 20 years. And if we went with the new RP 2014 with this new MP 2015 projection scale, we'd be looking at a life expectancy of 268 months, or just over 2 years of increase in life expectancy. So the simple conclusion is that it will be cheaper to pay lump sums in 2016 than it will be once this new mortality basis is implemented and effective. So that addresses the mortality changes happening. We also need to look at what's going on with interest rates. The interest rate conversation is a difficult one because there's so many different sets of interest rates floating around through different congressional actions and then what's required for audit purposes. So this makes for a difficult conversation, but the important part to remember is that for lump sum purposes, when you're doing a terminated vested buyout, for most plans, and again, this will vary specifically on how your plan document is written, but for most plan sponsors, they're setting their interest rates once a year, usually for a calendar year plan based on the November or December interest rates of the immediately preceding year. So for 2016, most of the plan sponsors have their interest rates locked in for the year and will not be reset for another year. So let's talk at a high level about what's going on with interest rates. For GAAP purposes, most plan sponsors at 12/31/15 probably used a discount rate of between 4 and 4.5%. And the November 2015 lump sum segment rates, which was probably the most popular look back, this 2-month look back, our 3 segment rates are 1.676%, 4.15%, and 5.13%. I'm presuming a little bit of knowledge of the Pension Protection Act here and how these 3 segment rates are built into determining that lump sum calculation. But what you can see here is just in the 3 months from November of 2015 to February of 2016, we've seen some downward movement in the 2nd and 3rd segment rates. But again, we would pay out, most plans would pay out using the November 2015 segment rates. So you're getting a little bit of savings there compared to how interest rates have moved the last few months. Translating these effective rates, translating those segment rates into effective rates, basically what we're saying, if you look at the bottom half of slide 9 here, for a 40-year-old, if we were to offer them a lump sum cash out, their effective interest rate, we'd be cashing them out, would be at 5.13% interest because we're not expecting them to commence payment for another 25 years. With our 50 and 60-year-olds, you can see the effective rate dropping the closer folks are to beginning payment. But it's important to note that even for the 60-year-old, the effective rate that we would do a cash out is 4.5%. And for most plan sponsors, that's probably the best they were looking at in terms of a discount rate for GAAP purposes. So the conclusion here, the important conclusion to draw is that paying a lump sum really should cost less than the PBO, the projected benefit obligation of the plan sponsors reserving for that benefit on their books. Effectively, what we're saying is, due to the difference in interest rates and how the interest rates are valued, for every dollar that you're paying out in the form of a lump sum, you're getting rid of more than $1 worth of PBO off of your balance sheet. So you're actually getting a little bit of gain from each of those transactions. We should talk a minute about the investments. This slide has evolved greatly over the last month from when I put together my first draft to today. A month ago, we would have been talking about how much the stock market had fallen apart throughout the first 6 weeks of the year. But we've seen a rally in the markets, and where we are at today basically is the S&P and the Dow are essentially back to even after a rough start. So what a month ago, if we had done this may have been a little bit more of a negative because there may have been some reluctance by plan sponsors to pull the trigger on a cash out right in the middle of a market dip. The market has recovered, and plan sponsors, from a funding status perspective, should be pretty much the same point they were at the beginning of the year. So this really hasn't, this has gone from being a negative to really a neutral over the course of the last month. Of course, what happens over the rest of the year is going to certainly be open to debate, and of course the presidential election and how that all plays into it will be very interesting, and I don't think anyone really wants to stick their neck out and make any bold predictions of the future. So that provides some of the background for the underlying determinations and how the lump sums are actually calculated. But one of the biggest drivers in this whole de-risking movement has been the continued increases in PBGC premiums thanks to multiple congressional actions. What we're seeing here for 2016, of course, is a per participant premium of $64 and a variable rate premium of $30. So again, that means for every $1,000 of underfunding, you're going to be looking at a $30 variable rate premium. And so with many plan sponsors still significantly underfunded, especially when we look at this on a PBGC basis, which is one of the most conservative bases that we use out there. Many plan sponsors are making very significant payments to the PBGC. And we even have some plan sponsors that are actually hitting that variable rate cap of $500 per participant. Now, if you're at the cap, that $500 cap, you're not the best funded plan, but that doesn't mean you're necessarily so significantly underfunded that doing a lump sum buyout doesn't make sense. In fact, we're seeing significant differences in funded percentage between what we do here for a PBGC basis and what we're doing just for, thanks to the HATFA rates that are in effect, you know, funding percentages for plans for AFTAP purposes are significantly higher. So it's very possible you could do a terminated vested buyout and even after reflecting those lump sum payments, still have a plan that's over that 80% threshold where we would have to start, you know, advising plan sponsors about benefit restrictions and having, you know, trying to avoid those kinds of issues. So if you're a plan that's at that cap, you know, again, if you're looking at, for every person that you would cash out in 2016, in 2017, that per participant premium is going up to $69, and the per participant cap will be, that $500 will be indexed. So we're looking at close to a $600 savings per participant for potentially for plans if they do some sort of terminated vested buyout or an annuity purchase for that matter. You know, the key here is just trying to get participants off of, get the participant count down out of plans that will lower the per participant premium and hopefully lower the underfunding of the plan as well. So we've talked, every slide up to this point has been very much, of course I would want to do a terminated vested buyout based on everything that's been presented up to this point. And there is some very compelling reasons why you would want to implement a cash out here in 2016. But we would be remiss if we didn't point out kind of the one big con that does give some plan sponsors some indigestion if it's important to them. And that is, in most terminated vested cash outs, certainly if you offer it to everyone, you can structure it to try to avoid such issues. But for most buyouts, you'd be looking at triggering settlement accounting under U.S. GAAP. And so what that means is almost all of our plan sponsors have significant net losses sitting out on their balance sheet. It's the accumulation of many years of subpar asset returns, the near historically low interest rates, and the improving mortality that we've already discussed. And what happens with either in a terminated vested cash out or in an annuity purchase, whatever the pro rata share of liability that you settle, you take the pro rata share of that from the net loss and you recognize that through the income statement. So, for example, you know, if we have, just to keep it simple, if we have a plan with $100 million in PBO and $10 million in net loss, and we settle 10% of that PBO, so we bring the $100 million down to $90 million, well, we would also recognize 10% of our net loss, or $1 million, would hit the income statement in the year in which you executed either a buyout or an annuity purchase. So for some plan sponsors, especially ones that are conscious about swings in their P&L and are paying close attention to their balance sheet, you know, that may be enough reason to not implement one of these programs. But still, I would say that the overall economics of this make a pretty compelling case of why you would want to do this. But of course, every plan sponsor needs to, you know, make that evaluation for themselves. So we've talked about, you know, all the issues surrounding these buyouts. So let's talk about the actual implementation and how you would pull it off. you know, the key is you would want to get these people out of your plan before year end. So for a calendar year plan, you would want to get these people paid out in December. So working backwards, you would probably, if you go with the usual 45-day window, you'd probably be looking at a window period of October 15th to November 30th or so, and that gives all of December to get everything processed and work with your trustee to get everyone paid out timely before the end of the year. Working backwards then, you know, the determination of whether you want to implement a buyout, you know, those conversations probably need to be occurring right now, and with a final decision to actually implement one probably by the summertime, so that you can put in all the pieces that are needed to implement this effectively, which means you're going to need to put in, have a formal plan amendment put into place. You may need to do some data scrubbing to make sure your benefits are calculated correctly. May need to do some address searches because people don't always provide a change of address when they move, especially if they're no longer a current employee. It's very common. So these are the kind of considerations and kind of things that you'll need to work through. On average, we see about a 50% take rate, depending on the communications program. You know, so if you're offering this a buyout to 200 people, we would expect on average 100 to 105 would take the buyout. One of the things we warn plan sponsors for is the call volume that comes with these. You know, generally we see 120% call volume, meaning that if we offered a buyout program to 1,000 terminated vested participants, on average, our experience is you'll get about 1,200 calls. So it's important to make sure, you know, either your administration team is beefed up to handle that, or you know, can work with you know, Finley Davies or someone else to provide those extra administration services for you. So I've talked a lot here about terminated vested buyouts, but I do want to spend a couple minutes talking about annuity purchase considerations as well. As I mentioned earlier, annuity purchases are becoming much more popular, again, as participants are as plan sponsors are trying to get their participant counts decreased. And so, you know, when you're looking at an annuity purchase, I mean, the goal here really is to remove the legacy costs and risks of your pension plan. And if you're just eliminating the retirees, what you also do is you're lengthening the duration of your remaining liabilities. For most plan sponsors that are still using, you know, some kind of yield curve methodology to determine their discount rate, you can see an increase in your discount rate since you're eliminating a lot of your short-term liabilities that are going to be paid out to your current retirees. With an annuity purchase, because most plan sponsors have adopted the new RP 2014 tables for GAAP purposes already, the premium that you're paying over your accounting liability is smaller than it was just a couple of years ago. And of course, we're looking to decrease those PBGC premiums, which again are probably the biggest driver for most plan sponsors. On the other side, again, similar to the terminated vested cash outs, we're going to be mindful of the settlement accounting, and depending on the number of retirees that you're settling, the more significant that settlement adjustment would be. We're also going to want to be mindful about your AFTAP percentage and how much and how big an annuity purchase and what the effect on your funded percentage, and make sure you avoid any benefit restrictions issues. And there still is, while the premium has shrunk from the difference between a termination liability and the PBO, while it has shrunk, there is still a premium that you're paying over that accounting liability. So, so there is a cost to that, and when you do an annuity purchase, most plan sponsors will see a little bit of increase in their net loss because of that extra premium that you're having to pay. Although I will say, certainly for publicly traded clients, most analysts still view these, even though there may be a premium to be paid, most analysts are viewing these transactions favorably, and so the anticipated fallout might not be as significant as you might think. Real briefly, I mentioned plan termination because a lot of the de-risking conversations ultimately are little pieces and little building blocks towards building towards ultimate plan termination. Most plan sponsors are still not in a situation where they can very seriously consider this, and of course it's a long process. So it makes sense to be having those conversations now, and there's things that plan sponsors can be doing now so that when economic conditions arise, that it does make economic sense to terminate the plan, that they'll be ready to execute quickly. And a lot of that would involve data cleanup, especially if you have a lot of legacy benefits or you've acquired companies and may not have the most accurate records. Going back and doing some of those due diligence things can be very helpful moving forward. And of course, Finley Davies or your actuary can work with your investment advisor and try to work up more sophisticated and try to come up with a plan to get you to a termination liability over a time horizon that makes sense for for the plan sponsor. So there's things we can do to help in the interim and to really get plan sponsors set up to pull the trigger when they want to. As anticipated, I took the full 30 minutes here, so we're not going to have time for questions here on the webcast. But if you do have questions about anything I've talked about here, I've gone over a lot of material in a very short time period. My information is up on the screen, and I would be more than happy to reach out to you individually and address any questions that may have occurred during this presentation. It was a fast 30 minutes. I thank everyone for their participation. I thank you for listening, and look forward to hope you'll join us on our next webcast. Have a good afternoon, everyone.